So today we're going to focus on the power of options. How do you use options to profit under any situation? So if you're ready, get your writing materials ready. Take lots of notes. I do hope some of you have watched my introduction to options on YouTube, so you can better follow today's session. At the same time, I know that there are going to be a lot of questions. When I first learned options over 15 years ago, I found it really confusing. All right, either because I was stupid or because the guy who was teaching me was not too good. And it took me quite a while to understand how options really work. So I do understand if it's new to you, it could be a bit more complicated than just buying stock. So if you've got questions, please post them on the chat group, and I'll do my best to answer your questions along the way, and of course towards the end of the webinar. All right, so let's begin. So the first question people ask would be, all right, so I know how to buy stocks, I know to trade stocks, so why learn options? In a nutshell, options allow us to profit under all market conditions. It's like a Swiss Army knife. It's extremely versatile and flexible instrument, right? So when you buy a stock, you can only make money if the price goes up. If the price goes sideways or goes down, you don't make money. Simple as that. But when you employ options, options allow you to make money regardless of whether the stock price goes up, stock price goes sideways, stock price goes down, goes in circles, makes a U shape. You can still make money on options. And I will show you how we do that in today's webinar. And at the same time, options allow us to lower our risk of our portfolio and allow us to use a lot less capital as compared to buying stocks. And at the end of the day, it helps us to boost our rate of returns. So whether you are a long-term investor or a short-term trader, you can use options effectively, right? So yesterday you learned that, as investors, we're kind of like, we're marrying the stock, right? As traders, we are one night stand, we are shagging, right? So whether you are marrying or shagging, you can use options. So for investors, so people who hold stocks for the long run, right? Fundamentally great companies that we talked about yesterday, like Microsoft and Amazon, these are great stocks to hold for the long run. How do you use options to boost your returns? Well, there are three ways, and we're going to cover that in today's webinar. The first way is by using options to earn a monthly income from your stock portfolio. And we use a method known as selling covered calls. And on average, I'm getting, well, not just me, but my students, we're getting around 2 to 3% return a month. Now, some of you may be thinking, that's all? 2 to 3%? Okay. Hey, 2% a month is 24% a year. That's not bad, all right? 3% a month is 36% a year. And we are able to generate 24% to 36% return a year on average, right, on our stock portfolio, even if the stocks go nowhere, go sideways, go down for 1 year. So that's the beauty of options. It allows us to earn extra income even if our stocks don't go up for 1 year. Okay, very, very powerful. The second way investors use options is by using options to buy stocks at a huge discount from the market price. Okay, so for example, you want to buy Microsoft, and Microsoft's at $200, but you don't want to pay $200 because you're a cheapskate like me, right? And you say, okay, I don't pay $200. I want to pay $190. I want to pay $180. So by selling cash secured put options, you can actually generate profits to pay for your shares. So at the end of the day, you can buy stocks at a discount of 2% discount, 5% discount, 10% discount, or even buy the shares for free eventually. That's right. And again, I'll explain more in detail in this webinar. So this is just an overview. The third way investors use options is to protect their portfolio. So we know that when we hold fundamentally great companies, in the long run, give me a second, right? In the long run, we know that the shares will always go up in value, right? Microsoft will always go up eventually. Amazon will always go up eventually. But in the short term, we could go through a bear market, as we talked about yesterday, right? When the market drops 20, 30, 40% in the short term. It can happen. So when that happens, we can use options to hedge our portfolio, to protect our portfolio. See, options are kind of like buying an insurance policy. So you buy this insurance policy, if the market drops, you get a payout of profits. The profits allow you to pay part of the unrealized losses of your stock portfolio. Okay, so again, we'll talk more about that in this webinar. So those are for investors. Now for traders, the shaggers out there, shaggy do, right? For traders, we can use options for directional trading. So as you know, in trading, we either go long, right? We buy low, sell high, or buy high, sell higher, or we go short on the stock. We sell high, we buy low, okay? Now, instead of trading the stock itself, we could trade using options, using call option spreads or put option spreads. So why use options instead of trading the stock itself? Well, options allow you to use a lot less capital, much less capital than actually trading the stock itself. And it allows you to reduce your risk. And again, I explain why later on. And results in a higher return on investment or ROI. The next thing that we can do as traders is use options for non-directional trading. And this is my personal favorite. In fact, most of the time, when I use options, it is for non-directional trading. So what does that mean? Non-directional trading are option strategies that allow us to profit regardless of the price direction. So many times I've got no idea. Is the stock going up, stock going down? I've got no clue. So I use a strategy known as snipebacks, invented by Bang Pham Van, who's my options partner. So snipebacks was invented by Bang, and it's one of my bread and butter strategies, which I'll talk about more later on. So again, snipebacks is a strategy where we make money regardless of market direction. And that's the best because we can't always predict where the heck the market is going to go, right? The third way we can use options as traders is for event-based trading. So an event is coming up. The Federal Reserve is going to announce interest rates. We've got no idea what's going to happen, right? Or the company's going to announce earnings. No idea what's going to happen. Could get up, could get down, could go nowhere, right? So for specific events, we could use options in a certain strategy, like the earnings sniper spread, again, invented by Bang. You can't learn this anywhere else. He invented it, right? And I love this strategy because we make money regardless of whether the stock beats earnings or misses earnings. We don't care a damn, right? And again, I'll introduce some of these strategies to you today, all right? So in a nutshell, that's why we use options. Let's start from the basics. So basically, there are only two kinds of options you can buy or sell. That's it, only two. You have got call options and you have got put options, okay? So let's learn what's a call option. Now, when you think of the word call, what do you think about? Calling. Calling is like buying. So this call option means it allows you to call the stock, to buy the stock, all right? So remember, call, okay, call, okay? So let's go into the actual specifics. So when you buy a call option, it gives you the right. You have the right to buy 100 shares of the underlying stock at a specific strike price that you have chosen, that you have locked in, okay? And you can buy the stock at this strike price anytime before or on the expiration date. Bear in mind that every one contract is 100 shares. One contract of options is 100 shares of options, okay? So, for example, this is what a call option looks like. Okay, So this is the Microsoft December 200 call options. Okay, so what does this mean? So if you buy this call option, it means that you have the right to buy Microsoft shares at the strike price of $200. $200 is the strike price that you have chosen. You have locked in the purchase price at $200. And so you can buy Microsoft shares at $200 anytime before the expiration date in December. So if you're using monthly options, the option expires on the third Friday of the month. Okay, on the third Friday of December, the option expires. So anytime before that, you can buy Microsoft shares at $200. Okay, so for example, if Microsoft shares are currently at 200 and just say for example $250. Okay, so if Microsoft is now at $250 and you own this option, what does it mean? It means you can buy Microsoft at $200, even though the share price is at $250. Okay, and if the share price goes to 500, you can still buy Microsoft at 200. If Microsoft goes to $1,000, you can still buy it at $200. So wherever the share price goes, it doesn't matter because you can buy it at 200 because you have locked in the price. So a call option allows you to lock in the price before the certain expiry date. Okay. Now to buy the option, you need to pay a premium. So in this case, to buy this option, for example, it costs you $8. So we call this the option premium. Does it make sense? Okay. So after you buy this option, if Microsoft shares go up, are you happy? Are you happy if Microsoft shares goes up? Yes or no? Yes, you're very happy, right? So for example, if Microsoft shares go to $220, you'll be very happy because you have the right to buy the shares at 200 and sell it at 220, which means that you're sitting on a profit of $20. Does this make sense? Okay. If Microsoft shares go to $240, you are even happier because you can still buy it at 200 and sell it at 240, which means that now you have an intrinsic value of $40. Okay. Now, as the share price of Microsoft goes up, what happens to this premium? What happens to the price of the option? The price of the option goes up as well. So for example, if Microsoft goes to $240, you have the right to buy it at 200, right? And sell it at 240, which means the options are now worth at least $40. Let me repeat that, okay? Let me repeat that. If Microsoft goes to $240, with the option, you have the right to buy it at 200 and sell it at 240, correct? Which means you can make $40 profit. So the options have an intrinsic value of $40. So the option premium from $8 will go up to at least $40. In reality, it'll go up even more than $40 because of the extrinsic value, okay? Now, in reality, people who buy options, listen carefully, people who buy options, they don't want to own the shares. I repeat that. People who buy the options, they don't want to own the shares. But they buy the option in order to sell the option at a higher price. So they're trading the options, okay? So you buy the option at $8, for example. When the share price goes up, the option premium goes up to $30, $40. You sell it, and that's how you make a profit. All right. So basically, that's how it works. Now, I know questions are coming in. Don't worry. I will answer them once I finish this part of the lesson. Give me a second. Okay. So let's take a look at how an options transaction goes. So in the market, you can buy an option, you can be the buyer of the call option, or you could be the seller of the call option. You can play either role. You can be a call buyer or you can be a call seller. Now, sometimes I'm a call buyer, sometimes I'm a call seller. So I take both roles depending, right? So let's look at a call buyer. So when you buy a call, you have to pay the premium. That's right, you pay the premium to buy the call. And by buying the call, you now have the right. Okay, you have the right to buy the stock at the strike price of $200. Now, who do you buy it from? You may say, okay, I can buy it at $200 from who? From the guy who sold you the call. Okay? So as a call buyer, I'm hoping that the stock price will go up. Correct? Because the higher the share price goes, the more valuable my call option becomes. Right? So again, I buy the call option and I have now the right to buy the shares at $200. So again, if the shares go to 300, 400, 1,000, I can still buy it at 200. So the higher the share price goes, the more profit I can make. And my options become more and more valuable. So that's why I buy the call. Does it make sense? Okay. So the call buyer buys the call and pays the premium. To who? To the call seller. So the person who sells the call receives the premium. Okay? So the call seller receives the premium, and by receiving the premium, the call seller is now obligated. The seller of the call is obligated to sell the shares at $200. So no matter how high the share price goes, this call seller has to sell the shares at $200. Okay? And he must sell the shares to the call buyer. So as the seller of the call, he's hoping that the share price will either go down or go sideways. Why? Okay? So if the share price goes down or the share price goes sideways, what happens to this call that has been sold? The call will expire worthless. The call option will become worthless, and the call seller will be able to keep the premium with no more obligations. So you follow so far? Okay. So again, let me give you an example over here, right? So imagine that the stock drops to 100. Give me a second, right? So imagine that the stock price drops to $190. Okay. If that happens, what happens to this call, right? At $190, the call buyer will not be really happy because the call buyer has the right to buy the shares at 200, but the shares are at 190. So now this option becomes worthless because why would I want to buy at 200 when I can buy at 190, right? So the call becomes worthless. The call buyer is not too happy, but the call seller is really happy because he sold the call, and the call seller is obligated to sell the stock at 200, but the stock's at 190, right? So this option becomes worthless. The call seller collects a premium and he gets the maximum profit, right? So that's how it works. Now, let me see if there are any questions which I can take over here. Let me see. Now, some of you are asking questions that I'll cover later on. So I'm only going to answer the questions that are relevant to what I've covered right now. Yep, okay, there are not really any related questions right now, so I'm going to carry on, okay? So let me show you how buying call options compares to buying stocks, okay? So what call options do is they allow you to control large amounts of stocks with small amount of capital, all right? So let's imagine that currently Microsoft is at $200 and you are bullish. You expect it to go to $220. So what could you do? The first thing that you could do is to just buy the stock, all right? So if you buy 100 shares of Microsoft at $200, what's your capital required? You need $20,000 in capital, right? And if Microsoft share price increases to 220, what are your shares worth now? Now your shares are worth 220 times 100, your shares are worth 22,000. Correct? Okay, so what's your profit if you sell the shares? So if you sell the shares, you get 22,000. But you paid 20,000 for the shares, your profit is $2,000. Okay? And you make $2,000 out of your initial capital of $20,000. So 2,000 divided by 20,000 gives you an ROI, a return on investment of 10%. We all understand that, right? Okay. Now, instead of buying the stock, what if you bought the call option? So let's check it out. So imagine you buy the Microsoft call options at a strike price of $200. Again, what does this mean? This means that by buying this option, you have the right to buy Microsoft shares at $200. You have locked in the price at $200. We call that the strike price. And buying this option is not free. You have to pay a premium, okay? So example, the premium that you pay is $8 to buy this option. So in this case, what is your capital? Your capital would be $8, which is the price of the option, okay? And remember, each contract is 100 shares. So you must always multiply by 100. So $8 times 100 is $800. Okay, so off the bat, you can see that by buying the call options, you only require $800 versus 20,000 buying the stock. But in both cases, you are controlling 100 shares. Okay, so options allow you to control 100 shares with a lot less capital. All right, so what if Microsoft increases to $220? Okay, so if that happens, you have the right to buy it at 200, right? You have the right to buy it at 200 and sell it at 220, which means that your options are now worth at least $20. We call that the intrinsic value of the options. But in reality, the options will be worth much more than $20 because there's time value and other extrinsic value, which we'll talk about later on. But for now, understand that the options are now worth $20. Okay? So $20 times 100 is $2,000. Okay? So now your options are worth at least $2,000. I repeat, at least. In reality, they will be worth a lot more because of time value, right? So you decide to sell your options, okay? So you bought the options at $800. You now sell the options at $2,000, okay? So what's your profit? Your profit is $1,200. So you made $1,200. Now, what capital did you use? Use 800 in capital, right? So in this case, what's your ROI? Your return on investment is $1,200 divided by $800, which is 150% return. So in a direct comparison, you can see that buying the options, number one, allows you to use much less capital, okay? Number two, it increases your return on investment from 10% to 150%. So that's the power of options, okay? Now, what's the catch? There's always a catch. There's no free lunch in this world, okay? The catch is that if Microsoft shares don't increase fast enough, by the expiration date, the call options you bought will be worthless. They will be worthless. In other words, your $800 will be zero, gone, kaput, finis. Okay, all right. Please remember that. Okay, so that is why we only buy call options for short-term trading. Never for investing. Okay, if you want to invest in a stock, you gotta buy the stock itself. You do not buy a call option because a call option has an expiry date. So if the share price doesn't move up in time, your options are worthless and you lose everything. Okay, so never use call option for investing. All right, or rather, never buy call options for investing. Okay. But you can buy call options for short-term trading, for one-night stands, because for one-night stands, you're getting in and out very fast. So you get in and get out fast and take profit fast. If it drops, you got to cut loss fast, which I'll talk more about that later on. Okay, so this is what it looks like. Now, when you buy 100 shares of a stock, okay, when you buy a stock, what does the profit and loss graph look like? This is called a profit and loss graph. On the y-axis, on the x-axis, right? The one here, this x-axis, this is the stock price, okay? So stock price goes up, stock price goes down, okay? Right now, Microsoft is at $200. So imagine you buy it at $200. The price could go up, the price could go down, okay? On the y-axis, you have the profit or loss. So this is the zero line. Anything above that is profit, below that is loss. So if you buy Microsoft at $200, what happens? For every $1, the stock price goes up, you make $1 in profit. Correct? For every $1, the stock price goes down, you lose $1 in profit for every one share. Now, in this case, you're buying 100 shares. So if Microsoft goes up to $20 to 20 $20 times 100, you make $2,000. Right? If Microsoft goes down by $20, you lose $2,000. So when you buy stock, it's always a straight line graph up. Okay. Now, of course, when you buy fundamentally good businesses, you know that they will always go up eventually. No worries about that. But if you buy lousy stocks, lousy companies, or overvalued companies, hey, they could go to zero, right? So stocks for one-night stands, for short-term trading, if they are not fundamentally good companies, they could go to zero. Okay. Now, so that's why when you are trading with one-night stands, it is safer to buy call options, because of a call option, it looks like this. Ta-da! It looks like a Nike sign, right? You know the Nike sign? Okay, it looks like a Nike sign. So when you buy a call option, what's the worst that can happen? So example, you buy the Microsoft 200 calls at the premium of $8. What is the worst that can happen? The worst that can happen is if the share price drops, even if the stock goes to zero, the worst that can happen is you lose your entire premium of $8. So the worst that can happen is you lose $8 times 100 shares, you lose $800. Right? So you can see that with a call option, the loss is limited to the premium that you paid for the option. You can't lose more than the premium. The premium is the max you can lose. Okay? But if the stock price, you can see if the stock price goes up to the heavens, you can make unlimited profit. So let me repeat that. When you buy a call option, it is limited risk, unlimited returns. Limited risk, unlimited returns. Because the worst that can happen is you lose your premium. The risk is limited to the premium. But maximum return, because if Microsoft goes to $1,000, for example, hallelujah, right? Because if it goes to $1,000, it means that you have the right to buy Microsoft at 200 and sell it at 1,000, making an $800 profit. So your options are going to be worth at least $800. So you buy the option at $8, the option goes to $800. My God, you make a killing, right? So you can see unlimited returns, limited risk. This is if you buy a call option. Now, let's flip your mind around a bit. What if you sell a call option? All right. If you sell a call option, the graph goes the opposite. Ta-da! It goes like that. If you sell a call option, right? So remember, when you sell a call option, what you get? You get the premium. You collect the premium when you sell the call option, right? And remember, this is the profit or loss. This is the stock price. Okay? So when you sell a call option, you're hoping that the stock price will go down. You want the stock price to go down, or you want the stock price to go sideways or go nowhere. If the stock price goes down or goes nowhere, what happens? That's right. You get to keep the premium. Right? So when you sell a call option, your profit is limited to the premium you collect. You can't get more than the premium because you sold the call, you get a premium, you can't get more. So the maximum profit is the premium. Right? But if you sell a call and the stock price goes up to heaven, oh my God, you have an unlimited risk of loss. I repeat that. When you sell a call option, you have limited profit, which is the premium, but unlimited risk of loss. Because if the stock price goes up to heaven, what happens? Then, okay, so let me give you an example. So imagine that Microsoft is at $200 right now. Okay, imagine the stock price of Microsoft is $200. Okay, and you sell a call option. Oops, that always happens. I don't know why. Okay, let me do that again. So let's imagine that Microsoft shares are now at $200. Okay, that's the stock price. And you sell the Microsoft call option at a, okay, tell you what, let me do it this way. I've got more space here. Okay, one more time. Okay, so let's imagine that Microsoft is now selling at $200. Okay, and you decide to sell the Microsoft call option at a strike price of $205. And you sell this call option at a premium of, say, $8. Okay, so again, what does this mean? It means that by selling this call option, you collect $8, right? You collect $8. This is the premium that you collect. Okay, and by selling this call option, you are obligated to sell the shares at $205. Right? You're obligated to sell the shares at $205. Now, what happens if Microsoft goes to $500? Then you are screwed. You are screwed because you are obligated to sell the shares at $205. Okay? But the shares are $500. Now, if you don't own the shares, what must you do? If you don't own the shares, you are forced to go to the stock market and you're forced to buy it at $500 and sell it at $205, which means you lose $300. If Microsoft goes to $1,000, then you are obligated to sell it at $205. But what if you don't have the shares? If you don't have the shares, you are forced to buy at $1,000 and sell it at $205, which means you lose $800. So the higher the stock price goes, the more you lose. So you have unlimited risk of loss by selling that call. So you may be saying to yourself, why would you want to sell the call? Okay. Now I sell calls every month. I love selling calls. Why? Because I own the Microsoft shares. Now, if you own Microsoft shares, you own the shares, you can sell the call. Why? Because you already have the shares. So if you already have the shares, there's no risk. Because if Microsoft goes to 500 and you're obligated to sell it at 205, you can sell it at 205 because you already own the shares that you bought at maybe $100. Okay? So the risk only comes if you sell the call without owning the shares. Okay? So don't ever do that. All right? Let's go back to that again. So let me repeat that. When you sell a call, you're getting the profit over here. If the stock price goes up, you have unlimited loss. But if you own the shares, no problem, because you own the shares and the stock price goes up, the shares you own will increase in price. And the increase in price will offset the loss in the call, which means that you still make money at the end of the day. We call that a covered call. And again, I'll talk about that more in detail later on. For now, just know, don't sell a call without owning the shares. Okay, that's all you need to know. All right. Okay, so let me summarize call options right now. So how do you make money from call options? Okay, there are two ways to make money from call options. The first way is to buy the call option, okay, and hopefully if the stock price goes up. Now, what happens when the stock price goes up? What happens to the call option? Will it increase in value or drop in value? It will increase in value, right? Remember, when you buy a call option, you want the stock price to go up. If the stock price goes up, the call option will become more valuable. So imagine you buy the call option at a $1 premium. Okay, you paid $1 to buy the call option. If the stock price goes up, for example, and now the call option is worth $2, you sell the call at $2. So you buy the call at $1, you sell the call at $2, you double your money. All right, so that's what most people do. The second thing you can do is you can sell a call at, say, $1. Now, selling a call is also known as writing a call. Okay, so when you hear the word, when you hear people say, I'm writing a call, it means they're selling a call. Okay, so when you sell a call at $1, what are you hoping? Remember, when you sell a call, you're hoping the stock price will go down. You're hoping the stock price will go down or go sideways. If the stock price goes down or goes sideways, what happens to the call that you sold? The call will fall in value. So for example, from $1, the call is now worth 10 cents, right? And you could buy the call back. So if you sell it at $1 and you buy it back at 10 cents, how much money do you make? You make 90 cents. You make 90 cents profit. Okay. So remember, whenever you're buying something, you want to sell it at a higher price. Buy low, sell high. Buy high, sell higher. Correct? But whenever you're selling something, you want it to go down in price. Sell high, buy back low. Okay, so in this case, you sell the call at $1 and you're hoping that it goes down in value. You can buy it back cheaper and make a profit. Now, of course, the best case scenario is you sell the call at $1 and the call goes to zero. The call becomes worthless. If the call becomes worthless, you don't have to buy it back because it is worthless. That's the best case scenario, right? Now, like I said, what happens if you buy the call at $1? As a call buyer, you buy it at $1 and the call goes to zero. What happens? You lose $1, right? The worst is you lose $1. So when you buy a call, remember, your loss is limited. If the stock price goes down and the call goes to zero, you can only lose $1. But when you sell the call, what happens? If the stock price goes up, what happens to this call? Remember, when stock price goes up, the value of the call goes up. So if the stock price goes up instead, and the call goes to $10, what happens? Then you have to buy it back at $10. You lose $9. If the stock goes up even higher and the call goes to $50, what happens? You have to buy it back at $50. You sell it at $1, you buy it back at $50, you lose $49. So as the stock price goes up, what happens? That's right. Your loss is unlimited. Unlimited loss. That's why when you sell a call, never sell naked. Never sell it naked. Okay? So when you sell a call, you need to own the shares first. Then it's okay. Because if you own the shares, you no longer have the risk of unlimited loss. Or, besides owning the shares, you could also buy another call at a high strike price to hedge the call you sold. Now, that's a bit more complicated, right? That's more in the advanced course. But what I'm saying is that you can sell calls, but you have to protect yourself by owning the shares or buying another call to hedge it, but never sell it naked. Please write this down and burn this into your brain. Never sell calls naked. If you sell calls naked, you will be naked yourself one day with no clothes, all right? Okay, so let me take some questions that are coming in. If some of you are a bit confused, all right, don't worry, it's quite normal, okay? Okay, Jeffrey, I'll answer that question in a while about in the money and out the money. Justin is asking, is there a difference when you buy a call and then sell the call from writing the call? Okay, now I'm confused, all right. Now, Justin, just remember that when you buy a call, okay, you have to sell it later on to make money, right? So you buy to open the contract, you sell to close the contract. If you start by selling a call, then you have to close it by buying the call back or by allowing it to expire worthless. Remember, every time you open something, you have to close it, Justin, right? You open it, you got to close it. So if you buy to open, you sell to close it. If you sell to open it, you have to buy to close it. Or if it goes to zero, you don't have to buy it back. Then in that case, you don't have to close it. Okay? Lim asks, Mr. Lim is asking, does the increase in the underlying shares in line with the increase in the option price? For example, if the shares increase by $20, the option increases by $20. Lim, good question. That will be answered in a short while under Delta. I'll be talking about Delta in a while, Lim. Hold on to that. Guan Wei is asking, how does the call option profit loss become realized? How does the call option profit loss become realized? Okay, so one way, like I said, you buy the call at $5, for example, and you sell it at $10. Once you sell it, you realize the profit. Okay, If you buy the call at $5 and the call drops to $2 and you sell it at $2, you lose the $3, right? So once you buy a call and you sell it, you realize the profit or the loss. If you sell the call at a higher price, you make a profit. If you sell the call at a low price, you make a loss, right? Okay, Mark is asking, do you need to have shares before selling options? Mark, you don't need to do it, but you have to do it. Okay? So like I said, you don't need to own the shares to sell a call option. You don't need to. You can sell a call option right now, but don't do it, because if you sell a call option without owning the shares, you are selling naked. Never sell naked, because if you sell naked, you are exposed to unlimited loss if the shares go up. So always own the shares first before selling a call option. Okay, Mark? Okay? Now, if you don't own the shares, there's another method where you could buy a call option and sell another call option. So as long as you buy a call and sell a call, they are hedging each other. But don't sell a call by itself, because that's called selling naked, right? All right. Let's see. Okay, rest of the questions are similar. And Anderson is asking, so Adam, are options more to technical analysis and speculation? Not really, Anderson. It depends. So you can use options for speculation. You can use options for protection. You can use options to generate extra income. So options are like a Swiss Army knife. You can use it for many purposes, which I'll go through in a while, right? Let me see what Brian is asking. When the price of Microsoft drops below 200, can the call buyer still insist the seller sell the shares to him? Okay, so Brian, for the call buyer, okay, if Microsoft shares fall below 200, the guy who bought the call will be upset because his calls will be worthless. The calls will be worthless, basically, right? And the person who sold the call will be very happy because the person who sold the calls will be worthless, and the seller will keep the premium with no more obligation to sell the shares. All right? Okay, Marjo is asking, what is the right time to sell calls? Marjo, I'll go through that in a while under selling covered calls, which is the strategy later on. Just to confirm, Adam, Raymond is asking, to buy options, do I need to prepare capital based on the share price, or can I just prepare based on the premium price? Okay, so Raymond, remember, most of the time, people who trade options, Raymond, they don't want to own the shares. They do not want to own the shares. Okay, they are buying the call option with the hope of selling the call option at a higher price without ever owning the shares. So Raymond, when you buy a call option, you just need to have the money to pay for the call option, which is the premium. You don't need the money to buy the shares because you don't want the shares, okay? So the purpose of buying call options is so that you don't need capital to buy the shares, okay? Okay, Kelvin, I'll answer your question on covered calls in a short while. Hold on to that. Okay, great questions coming in. Thank you very much. Okay, so let me move on. So now we know about call options. How about put options? So call is buy, right? Calling the shares. Put the shares is selling, okay? So when you buy a put option, what happens? So when you buy a put option, it gives you, the buyer, the right. You have the right to sell 100 shares of the underlying stock at a certain agreed on price. We call that again the strike price. Okay, so you've locked in the sale price anytime on or before the date of expiration. And again, you can choose any expiration date. It can be 10 days to expiration, 50 days, even 2 years to expiration, right? More on that later on. So for example, this is a put option. How do you read this put option? So this is the Facebook January 150 strike put option. So again, if you buy this put option, what does it mean? It means that you have the right to sell Facebook shares at $150. You have locked in the sales price at $150. So you can sell Facebook shares at $150 anytime before the expiration date, which in this case expires on the third Friday of, should be January. Okay, so anytime before the third Friday of January, you can sell Facebook shares at $150. And of course, to have this special contract, you have to buy it. You have to pay a premium of, in this case, $5.80. Okay, there we go. So if Facebook, for example, Facebook drops to $130, as the person who bought this put, are you happy? Are you happy that you bought the put? Yes, because you have the right to sell Facebook at $150, but it's now at $130, right? But you can sell it at $150. No, I can sell it at $150. Now it's at $130, right? So theoretically, you can sell it at $150 when it's now at $130. So which means you could buy the shares at $130 if you wanted to. You could buy the shares at $130 and sell it at $150, which means that you have a profit of $20. So the put options are now worth at least $20. Okay? So if the put options are now worth $20 in premium, you can now sell it at a higher price, right? So you bought the option at $580, you sell it at $20, you make $14.20. What if Facebook goes to zero? Okay, what if Facebook drops to zero? Now, of course, that's not going to happen, but let's just imagine. If Facebook goes to zero, are you happy? Yes, you're very happy, because if Facebook goes to zero, you have the right to sell Facebook at $150. No. So in other words, you could theoretically buy Facebook shares at zero and sell it at $150, making a profit of $150. So now the options, the put options, are worth $150. You bought it at $5.80. You sell the option at $150. You make $144.20. Something like that. I'm not really good at mental math, but okay, something like that. Does it make sense? Okay. So in other words, the more the stock price drops, right? The more Facebook drops in value, the more valuable the put options become, right? So the stock price drops, the put options increase in value, and you can sell it at a higher price. So you buy the put at $580, you could sell it at $10, at $50, and so on and so forth. Okay. Now, I got a question coming in over here, very common question. Adam, do I need to own the shares before buying a put option? No, you don't have to. You don't have to own the shares to buy a put option. You don't have to own Facebook shares to buy a put on Facebook. All right. In fact, like I said, most of the time, people who buy put options, they don't own the shares at all. They don't own the shares. They buy a put option in order to bet that the shares will fall. because when the shares fall, the puts become more valuable and they can sell the puts at a higher price. Okay? Let's see if there are any more questions coming in. Sue is asking, how much money should we have to do options? It depends, Sue. Like, Sue, there are some option strategies that require only $50 or $100. There are some option strategies that require a few $1,000s. So it depends on the strategy. But if you have an account that has $2,000 or $3,000, you can already use a lot of option strategies. All right. Okay. So, yeah, I see some more questions. I'll answer them in a while. Okay. Let me move on. All right. So again, let's look at the transaction right now. So again, you can be a person who buys a put option or the person who sells the put option. You can play either role. Okay. Sometimes I buy a put, sometimes I sell a put, depending on my mood, depending on what I want. Okay. Okay. So if I buy a put option, I have to pay a premium. Right? As whenever you buy an option, you have to pay the premium. Okay. Now, who collects the premium? The person who sold the put, right? So the guy who sold the put to you receives the premium. Now, as the person who buys the put, you have now the right. You have the right to sell the shares. Remember, 100 shares. One contract is 100 shares. You have the right to sell 100 shares of stock to the put seller at the agreed upon strike price. So in this case, you have the right to sell the shares of Facebook at $150. Okay. So as a put buyer, you are hoping the stock price will go down. All right. So again, if the stock price goes down, what happens? Your puts increase in value. The puts become more expensive and you can sell the puts at a higher price. All right. So you bought the put for a $1 premium. You can sell the put for a $3 premium, for example. All right. So remember, even if the stock goes to zero, you still have the right to sell the shares at 150. Okay. Now, for the person who sold the put, he receives the premium. He gets the premium, right? Now, and by receiving the premium, the put seller is now obligated. He's obligated to buy the shares at the strike price. The put seller is obligated to buy the shares at the strike price of $150. And buy the shares from who? From the put buyer, obviously, right? So as a put seller, all right, in general, they want the stock price to go up or to go sideways. Okay, so again, what happens if the stock price goes up? So for example, if Facebook goes up to $200, okay, if Facebook goes to $200, what happens to this put option? This put option becomes worthless, right? Because the put option allows the buyer to sell the shares at 150. But why would you want to sell at 150 when the stock's at 200? So this option is pretty useless, right? So when the stock price goes up, the option loses its value. It becomes more and more worthless until it goes to zero at expiration. So when it goes to zero, the put seller is no longer obligated and he keeps the premium. Okay, so that's how it goes. Okay. So this is what the profit and loss graph looks like for a put buyer. So again, on the x-axis, we have the stock price. On the y-axis, we have the profit and loss. This is the zero line. Above this is profit, below this is loss. So, question, when you buy a put, okay, and the stock price goes down, okay, so when the stock price goes down, what happens? You make a lot of money. The more the stock price drops, the more money you make. Until the stock goes to zero, you make the maximum profit. All right. So as a put buyer, you're praying the stock goes to zero and you make the most profit. But what if the stock price goes up? Right? If you buy a put option and the stock price goes up instead, what is the worst that can happen? The worst that can happen is the put becomes worthless and you lose your premium. You lose $5.80. So you can see that there's limited risk and very high return on buying a put. I repeat that when you buy a put, limited risk because you can only lose the premium, but almost unlimited profit if the stock price collapses. Okay. Okay. So how do you make money from put options? Again, there are two ways to make money. The first way is you buy a put option. Now, again, when you buy a put option, when you are bearish, when you think that the stock price is going to go down, you think the stock price is going to drop, you buy a put option. So you buy a put option at, say, $1. That's the premium, right? And if the stock price goes down, what happens? The value of the put will go up to $2 or $3 or whatever it is. So how do you take a profit? Well, you buy the put at $1, you sell it at $2, you make double your money. All right. Do you remember 9/11 when the terrorists crashed their plane into the Twin Towers? Remember that? They found out later on that Osama bin Laden, the reason he did that was not just because he wanted to kill people, right? He did that to make money. What they found later on was that before the planes hit the Twin Towers, there were a lot of people, probably the terrorists, who bought put options on the S&P 500, right? So the terrorists, they bought a lot of the put options on the S&P 500. And then they crashed the plane into the Twin Towers. When that happened, the stock market, if you remember, collapsed. When the stock market collapsed, the put options from $1 were worth $200 or $300. And that's how the terrorists made billions of dollars, right, through the 9/11 terror attack. So it wasn't just about killing people, it was making money, right, which is, of course, disgusting. Bastards, go to hell. All right, but that's how they use put options, basically. Okay, all right, so that's one way to make money from put options. Now, please don't do that, right? Don't go crash a building, yeah? Okay, the second way to make money is by selling a put option. Now, you sell a put option when you expect the stock price to go up or to go sideways. In other words, you don't expect it to go down, right? So you sell a put option at, say, $1, okay? And if the stock price doesn't go down, the stock price goes up or goes sideways, what happens to the put option? The put option becomes worth less. It is worth less. From $1, it's now worth, say, 10 cents. So you buy it back. So you sell it at $1, you buy back at 10 cents, you make 90 cents. Okay? Now, of course, the best case scenario is that the put goes to zero, right? It expires worthless. If it goes to zero, you don't have to buy it back anymore because it's zero, right? And so you keep the $1. Na, 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 na. Here we go. Okay. Now, again, what happens if, in this case, when you bought the put, What happens if the stock price goes up instead? If the stock price goes up, this put could expire worthless. And the worst that can happen is you lose your $1. So remember, when you buy a put, the worst that can happen is you lose $1. Okay? But if you sell the put, and what happens if you sell the put and the stock price drops? If the stock price drops, what happens to the put? The put will increase in value, right? So if the stock price drops and the put goes to $5, what happens now? Now you have to buy it back at $5. So you sold it at $1, you now buy it back at $5, you lose $4. If the stock price drops even more and the put goes to $10, what happens? Then you sell the put at $1, you buy back at $10, you lose $9. Okay? So you can see that when you sell a put, again, you have got the possibility of losing a lot of money if the stock price collapses. Okay? And that's why you never want to sell naked, as usual. Never sell naked. Okay? So whether you are selling calls or selling puts, never sell naked. Because if you sell naked, there's unlimited loss or very big loss. Okay? So I sell puts all the time. I sell it all the time. I make a lot of money selling puts, but I don't do it naked. I wear my clothes. So I do what we call selling cash secured puts on only very, very, very fundamentally good companies that have passed the 7 steps I talked about yesterday, and then I know the share price will go up eventually. Then I sell puts. Like Warren Buffett sells puts, same thing. So that's not selling naked, because that means you are prepared to own the shares at the strike price. Okay? So again, more on that later on. But I want to just understand, don't sell naked. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.